Market crashing? Before you panic sell, this simple investing checklist could save your portfolio. Most investors lose money not because of the market, but because they ignore risk management, timing, and emotional discipline.
You know that feeling, right? The market's in a free fall and every fiber of your being is just screaming, sell, get out. But what if you could silence that panic? What if you had a simple, powerful checklist to guide you? Well, that's exactly what we're building today. Your own personal guide to turn that fear into a confident, actionable plan. So here's our game plan. We're going to start by getting our heads in the right space, calibrating our mindset. Then we'll build 2 super important checklists, one for you and one for the stocks you're looking at. We'll even walk through a smart, disciplined way to buy in a downturn. And then we'll wrap it all up with a clear framework you can use every single time. All right, first things first. Before we even think about touching our money, we have to fortify our most important asset, and that's our mindset. In a crazy market like this, your perspective isn't just part of the strategy. It really is the strategy. Look, here's the thing you have to get straight. The 24/7 news cycle, all the headlines, a lot of it is designed to make money from your fear. It's so important to remember that markets have a 100% track record of recovering from every single major crisis in history. We can't control the wild swings, no way, but we can absolutely 100% control how we respond to them. Okay, so with that foundation in place, let's switch gears from mindset to mechanics. This first checklist, it's all about you. It's designed to give you a really clear yes or no on whether you should even be thinking about putting new money to work right now. This right here is the ultimate gut check, and you have to be brutally honest with yourself. If you put $1,000 into the market today and next month it's suddenly worth 800, are you going to lose sleep? Are you going to be tempted to hit that sell button at the worst possible time? If the answer is yes, that's a huge red flag. And let me be really clear about this. There is absolutely no shame in sitting this one out. If all this volatility is going to mess with your peace of mind, then waiting is seriously the smartest financial move you can make. Knowing your own emotional limits, well, that's a sign of a truly mature investor. Next up, your time horizon. You got to remember, market recoveries aren't fast. They can take years to really play out. So if you think you might need this cash for a down payment or a wedding or anything major in the next 5 years, it absolutely, positively does not belong in the stock market right now, period. Okay, now let's talk about your secret weapon, your future income. Think about it. A 25-year-old who's just starting their career is in a totally different spot than a 60-year-old who's getting close to retirement. Your strategy has to reflect that reality. And you can see it right here. If you're young, you've got decades of paychecks ahead of you. You can systematically invest, lower your average cost. It's a huge advantage. But if you're getting close to retirement, the game completely changes. Your main goal isn't about growing your wealth anymore. It's about protecting what you have. Taking big risks in a downturn just isn't worth it. And this is the last, and I mean non-negotiable question on this checklist. Where is this money coming from? I get it. When stocks look cheap, it's so tempting to maybe dip into your emergency fund or even borrow money. Let me just say, that is a recipe for absolute financial disaster. We are only ever talking about investing true surplus cash that you can afford to lose. So, if you pass that personal checklist with flying colors, you're cleared to proceed. But how you invest in a downturn is just as important as if you invest. So let's dig into a disciplined strategy that takes all the emotion out of the equation. This rule-based system is basically your defense against your own emotions. You make your first buy, then you have 2 and only 2 pre-planned moments to add a little more if the stock falls. This helps lower your average cost. And then, and this is key, you stop. This whole system is designed to stop you from throwing good money after bad or trying to catch a falling knife. And here's why that 6% number is so important. This simple rule forces you to stay diversified. No single company, I don't care how much you love it, should ever have the power to completely wreck your portfolio. This 6% ceiling is what protects you from a total disaster if one of your picks just doesn't work out. Okay, so you're mentally ready, your finances are solid, and you've got a smart buying strategy. Now for the million-dollar question. What do you actually buy? Let's get to our second checklist, the one that helps us find high-quality companies that can actually survive this storm. First, you've got to get this mindset right. It's so easy to hold on to losing stocks, just hoping you can get your money back. But that's just your ego talking. It's an ego trap. A downturn is actually the perfect time to prune your portfolio. Sell the weak companies, the barren trees, and move that money over to your proven winners, the fruitful trees, especially while they're on sale. So that brings up a really important question. When everything's going down, what does low risk even mean? We're not just looking for cheap stocks here. We're on the hunt for businesses that are financially indestructible, the kind of companies that are built to survive a recession and come out even stronger on the other side.
And this is our quality filter. We're looking for 4 things that are totally non-negotiable. First, is it a dominant player in its industry? Number 1 or number 2? Second, does it have a long history of making it through past crises? Third, does it have a fortress-like balance sheet with more cash than debt? And finally, a clean promoter holding. This just means the founders haven't put up their own shares as collateral for loans, which can be a sign of trouble. These are the signs of a business that is built to last.
So, let's wrap this all up. We've gone from the pure chaos and panic of a market downturn all the way to a structured, logical plan. You now have a real framework for deciding when to act, what to buy, and just as important, when to just sit on your hands and do nothing at all. Honestly, this whole thing boils down to a simple 2-step process. First, you run the checklist on yourself. Your money, your emotions, your timeline. Only if you get a green light there do you even think about moving on to the second checklist and applying that strict quality filter to a stock. It's always you first, then the company. That's the golden rule. And I guess this is the question I really want to leave you with. A disciplined plan, like the one we've just talked about, is what separates the people who build long-term wealth from the people who just sell in a panic. It is how you turn all this market chaos into a real opportunity. So take an honest look at your own portfolio. Is it built on a plan, or is it just a reaction to all the noise?
Build a smarter strategy. Follow for stock market tips, investing during a crash, and long-term wealth strategies.